The need for investment capital cannot be overemphasized. This is evident among micro, small, medium, and large-scale businesses. It's important to commit that time, talent, and resources to truly understand the possibilities that exist among debt capital portfolios, equity capital portfolios, credit capital portfolios, and the one that is not so often talked about is credit capital. Today, I want us to take a high-level overview of private equity and venture capital funds. In today's brief overview of this financial portfolio, I will give a definition of what is private equity fund, a definition of what is venture capital fund, a definition of what is a closed-end fund. We will also look at the finance life cycle, and last but not least, we will look at issues relating to the management fee and exit strategy. I want to show you that if you are an entrepreneur and you're considering alternative financing possibilities, and that possibility happen to be looking into private equity funding, this program will give you a tremendous amount of information. However, in the event that you're joining me for the first time, do permit me to introduce myself. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author for several books, including Manager's Toolkit and Billionaire Quotes. My most recent book is titled 10X Branding and Marketing Blueprint, Business Ecosystem, and you don't want to miss those books. I want to give you a little bit about my academic background, which I don't so often talk about, but I studied at American University of Peace Studies. I studied Cambridge University and programs, and I have also studied Rice University. And one of those programs that I have studied at Rice University is titled The Global Financial Markets and Instruments. Today, I'll be talking to you, trying to combine experiences from those academic studies in today's program for you. So let's start the process. When one talks of private equity funds, what exactly are we talking about? Now, let me look at this by drawing a distinction. There is what is known as private equity and public equity. Now, the private equity is when you identify private investors for your company. And private investors can come from a multiple of sources, and I will give you examples of those not so long ago. But private equity is where you're able to source funding from private institutions as against public institutions. Public institution is where you must be listed as an IPO in order to source funding from the public source. So those are the two distinctions. Now, private equity investors, in 99.1% of the cases, they are not necessarily looking for business startup. They're not looking at businesses that are now in the incubator stage. They're looking for businesses that has a healthy financial track record, and they have a strong team in place to move their operation forward. Why? Because they are risk averse. And here lies the difference between the private equity investors and the venture capitalists. The venture capitalist is more receptive to risk. And venture capitalists are those individuals who may take a business pre-income, meaning that you are now in the brainstorming process, but you're brainstorming perhaps some new innovation that can have tremendous impact on society once you're able to make that breakthrough. So you have to do the research and ensure that you are gathering critical data to complement that innovation process. The VCs are those individuals who are likely to invest with you at this stage. All right, VCs are also persons who are going to come with a tremendous amount of knowledge. They were going to come to get skin in the game. So along with providing you with the investment capital, they're coming with market intelligence. They're coming with the necessary skill sets to help in the fast tracking of your brand. Most VCs, or my advice to you is that if you're seeking VC fund, it makes sense to seek the VCs that has a tremendous knowledge base, a tremendous network base that can help you in that process. Now, here you have some clarity in terms of the difference between what is a private equity fund and what is the venture capital fund. They're two different. Now, both of these financial portfolios is what is known as closed-end fund. Now, what exactly is a closed-end fund? A closed-end fund simply means that these funds only last a finite period, meaning that they do not last forever. They last for a finite period. And I will talk about that just now. So it is important for you to know this. And at the end of this fund life cycle, the VC or the PE wants to cash out of this whole arrangement. So you need to keep this at the back of your mind as you start to think about alternative financial sources. Now, funding life cycle. This is something that I want us to really get into a little deep today. As we talk about the funding life cycle, it's important to recognize that most PE and VC funds may last between 5 to 10 years. It might be pushed to about 12 years, but it's important for you to understand this, all right? Because understanding this can make a major difference as it relates to when it comes to issues like the VC or the PE exiting that portfolio. There's a lot that you need to think through when it comes to accessing VC and PE fund, all right? Now, as we talk about this subject matter, I believe it's important for you to understand 4 important realities as relates to the fund life cycle. There are several things that happens during this fund life cycle. One of the first things that happens here is that the VC or the PE, they are heavily involved in fundraising exercise. So the first period is what you call the fundraising period. Now the question here is, where are they raising funds from? And the reality here is that they can raise funds from a number of sources that is better known as the LPs, limited partners. Like for example, the VC or the PE, they can raise funds from what is known as the SWF. SWF, the acronym means Sovereign Wealth Fund. Later on, I'll go deeper into all of these funds to help you to understand the significance of that. Along with this sovereign wealth funds, you have things like pension funds. And throughout the world, if you're to do a data analysis of funds that are generated on a monthly basis via the pension fund, you will see, depending on population and how many persons are contributing to that fund, you have billions of dollars that are circulating here. And these funds, in most cases, go on to some form of asset management. The PE and the VC are some of those persons that take these funds to invest them. All right? Other players that may help to invest them is what is better known as the boutique investors or the boutique intermediary or the global intermediaries. Now, along with the sources that the VC or PE source funds from may be also insurance funds. This is a tremendous opportunity open here. All right, later on I get into all of those technicalities. But along with this, you have endowment funds. you have high net worth individuals, and you also have super high net worth individuals. So these are some of the funding sources, all right, that are available to the VC and the P. Now, the question that I want you to ask yourself here, SWF, pension funds, insurance funds, endowment, high net worth, super high net worth individual, these individuals do not have funds available, but they have funds available for investment, all right? And the reason they may look to a PE or a VC, venture capitalist or a private equity investors, is because they want to cash flow their excess liquidity above standard market rate. So this is an option that is available to them. So the VC or PE, they have an obligation to manage these portfolios well. It's not a gift, all right? Now, so here is where you understand where the VC and PE are likely to source their capital from. But let's go one step further. Let's talk about the investment phases. Now, the VC in the fundraising period may raise capital over a number of years. Like, for example, in assessing your business portfolio and your financial need, it may show that within the first year, you need this amount of money. So the VC or PE, if for the first year, raise X amount of funds, they will not necessarily release the entire fund sum to you in one instant. It's going to be allocated to you in an incremental basis. It's important that you recognize this. And the phases normally last, the phases of what we call the investment phase normally last between 1 to 5 years, all right? 1 to 5 years, and it's important to recognize this. This might also be considered the holding period. Now, what happens after this period? At the 5-year mark, the VC and the PE, they are beginning to implement the exit strategies. And this, I cannot overemphasize the importance of recognizing this. And the failure to recognize this can really hurt you, all right, and hurt so many other persons with you. It's important to take the time to understand this. Now, during this period, the investment phase, and as you get past the investment phase, the last 5 years of this portfolio, the VC or the PE, they may be raising funds, but they're not necessarily raising the funds to come back into your business, because your business has reached, the investment sum that has been pumped into your business has been allocated. So now the VC wants to develop and implement in the exit strategies. Remember, there's no free lunch in business, and it's important that you recognize this. And it's important that you have the right advisors that can help you to see through this entire process and make informed and educated decision about accessing VC and PE fund, venture capital and private equity fund. Absolutely necessary. Now, several things happen here again. By the 6th, 7th year, the VCPE, they're raising capital to ensure that they are paying back the monies that you would have borrowed from either SWF, pension funds, insurance funds, endowment, high net worth, super high net worth individual. They have an obligation, because remember, I did say that this is a closed-end fund. It comes to an end at a particular life cycle. The life cycle of this fund comes to an end within 10 to 12 years. And at the end of the life cycle of that debt, all monies borrowed has to be paid back. So the safety net that the VC and the PE will put in place is that halfway in that debt life cycle, they start identifying funding source to pay off back that debt. Remember, they too have their credibility at stake. and failing to reach those financial deadlines of the obligation, it can undermine their credibility and undermine their chance and opportunity to raise capital and build a healthy relationship with financial institutions. So there's logical reasons for them to do what they're doing. However, as they protect their interests, the possibility exists, if you're not aware of all the realities around this agreement, you can be exposed. All right? You can be exposed. Because as the PE and VC raise capital to pay off the first debt, pay back capital to the LPs, the limited partners, they are raising capital from several sources. For example, you have the trade sales, you have the security sales, secondary sales, you have what is known as the initial public offer or IPO, you have recapitalization, and you have liquidation and write-off. These are several options that the VC and the PE have as a part of the exit strategy. Now, each one of these strategies, exit strategy, has implication for you and your business, and you need to know this. For example, let's suppose that the exit strategy is to take you IPO. If you go IPO, it means that you now will be listed in the public domain. All right, this is not all bad. It can mean tremendous amount of good. And I just want to give two quick examples here. One, going public is different from what we call a closed-end fund. A closed-end fund has a life cycle. But when the VC or the PE takes you public, it now means that you are almost infinite, all right? Meaning that the life cycle of the debt, the public debt, can go on for years and years and years, and that portfolio can keep increasing and increasing and increasing. You can also have a second rung of raising capital when you go IPO. But the question that you want to ask yourself is, are you prepared to go IPO? So as you start to consider the importance of a mixed capital market, it's important to ensure that you have the right support, the right advice to mentor and coach you through this process. And one of the things that you must keep at the back and center of your mind is what we call the term sheet. The term sheet. Any agreement that you need, you're going in to make sure that you get the term sheet and make sure that you work with your team of analysts to analyze that term sheet to really assess your exposure. Failing to do this, all right, failing to do this, you can be exposed at points that you're really not ready for that kind of exposure. I will not go into all of the technicalities now, but I want to show you, in the event that you need more information, feel free to reach out to us, reach out to our team at Global Capital Inc. and 10X Branding and Marketing LLC out of New York. We have a team of subject matter specialists to work with you on this. We have a team of lawyers, we have a team of certified public accountants, a team of economists, a team of business consultants, and so much more to put their best foot forward to work with you. So it's important to know that there's something that we call the term sheet and how important it is to analyze that term sheet before you sign off any agreement as you decide to go into private equity or the venture capital fund. I want to talk about briefly two risks associated with any debt portfolio. Now, there is risk that is better known as systematic risk, and you need to be aware of it. And because when you're taking debt, sometimes in most cases, you just know that you want the capital, or when you're leveraging part of your equity for funds, you're just thinking you want the capital. But a good advisor will help you to understand what is systematic risk and how to build out those risk mitigation portfolios. They will also help you to understand what is known as idiosyncratic risk and help you to build out appropriate platforms to mitigate those risks. All right, it's important. Any form of risk, you need to be aware of this. Now, what I want to talk about as we wind down today's program is what we call the management fees. How does it work? How does a venture capitalist and the private equity investors make money from this entire portfolio? Well, it is simple. Well, not so simple, but it's as simple as this. There is a 2% management fee, which we call the 2 and the 20. There's a 2% management fee on the investment portfolio. So let's take, for example, the VC or the PE raised $1 billion for you to pump into your business development. They're entitled to 2% management fee. And that 2% management fee is to give them that support to look over the portfolio, manage the portfolio. So for along with that, they may have a seat on your board, which means that they're going to become a GP and a member of your board, and their advice and support you will also represent that. Remember also that the PE and the VC, they are into this for cash flow maximization too. So they will also be entitled to a 20% of what is known as the net profit at the end of the life cycle of that portfolio. So they too want the life cycle to come to an end, because here is where they're going to cash out. So it's important that you keep this in mind. But remember, the right VC and the right PE, they are not just coming to, you don't want the type that just come to put the money in your pocket. That might be good, but you want them that comes with market intelligence, that understand the market accommodators and market enablers, and can activate them and leverage them to help to significantly fast track your business potential to grow and your business potential to cash flow. There's also what is known as the 8% hurdle rate. Now, the 8% hurdle rate is paid directly to the LP, your limited partner. And remember, and I must emphasize this, no money except the 2% is paid to the GP, the general partners, until all of the monies are paid back to the LPs. And the LPs, limited partners, are the SWF, pension fund, insurance funds, endowment, high net worth, super, and high net worth individual. All monies must be paid back to these individuals before any profit sharing. So hence the need, when the VC and the PE comes in, they want to drive your business to ensure that your business is cash flowing, because they do not have time to waste. They're in the business to make money, at the same time to help you achieve your business and your business strategic objective. Now, there's also something that we call the distribution waterfall. And that's when the first rung of distribution has been allocated. If there's any left over, we talk now about the distribution waterfall. I will not go into all the technicalities today, but today I just wanted to give you a high-level overview of what you're getting into when you are beginning to look at venture capital fund and private equity investment. All right, so there's a number of questions I want you to ask yourself as I bring the curtain down on today's program. Equity capital is not for everyone. I must emphasize this. Equity capital is not for everyone. And I would say the same when it comes to debt capital and credit capital. It's not for everyone. Do you know why I'm saying this? I urge you to get enough skin in the game, reach out to me so we can have this kind of conversation, so you know when is the best time for you to start taking equity capital. All right. Now, private equity investment, you need to understand if it's right for you. Venture capital funds, you need to ask yourself if it's right for you. All right. Perhaps you may not be able to make that decision for yourself because You may not be the financial expert. In the event that you need support, help, reach out to us. We will have our team do the due diligence to see where your company is at and make an informed decision as to whether you're ready for it or whether you're not ready for it. Now, if you go expose yourself here early, you could be taking on risk that you're really not ready for. There's a right time and there's a wrong time to take that. There's a right way and a wrong way to take that. Are there alternative financial instruments that are available that you can use? Perhaps you can consider bootstrapping in a very strategic way. We can give you support to do this. Perhaps you can start thinking about crowdfunding and sales funding in a strategic way. And these platforms can be built out that allows you to be completely divorced from debt obligation and dividend yield obligations. So it's important for you to expose yourself to what I'm talking about. And when you get past this phase, then you can now start thinking about angel invest. You can now start thinking about incubator and accelerator. You can now start talking about venture capital and growth capital, and the list goes on. Now, I really trust that you enjoyed today's program. If you're in business or you intend to get into business, I want to encourage you to like, subscribe, and share. So you will be the first to get these content that we're bringing to you on a regular basis. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author for several books, including Manager's Toolkit and Billionaire Codes. My last book is titled 10X Branding and Marketing Blueprint, Business Ecosystem. Again, a little bit about my background, which I don't talk a lot about. I studied at the American University. I lectured at the American University of Peace Studies. I also studied at Cambridge University International Program, and I also studied at Rice University. And one of the programs that I did at Rice University is Global Financial Markets and Financial Instrument. I trust you would have enjoyed today's program. Again, if you like it, just press that notification bell so you will be the first to get these programs that we bring to you on a regular basis. Be blessed.